a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about the special rebalance of the Nasdaq-100 index and related ETFs, which are very, very popular with investors. So we know that the rally this year has been driven mainly by the Magnificent Seven stocks. So that is why this tech-heavy Nasdaq 100 index has surged over 40%. And the weight of these seven stocks, the Magnificent Seven, that was over 55% as of last week. So the Nasdaq 100 index is a large cap growth index, which basically holds 100 largest non-financial companies that trade on the Nasdaq exchange. And this index follows a modified market cap weighted methodology. And the index rules require that individual constituents should not be more than 24% of the index weight, and all constituents with weight individually exceeding 4.5% as a total collectively should not be more than 48% of the index. So this is the limit that was exceeded, and when that happens, then the index has to undergo a special rebalance. Now, this is only the third time that this index has been rebalanced. The previous two rebalances were in 1998 and 2011. So now let's take a look at what basically drove the need for this index rebalance. So all these top holdings, they surged. Nvidia 210%, Tesla 140%, Meta 136%, and even the big ones like Apple is up more than 50%, Microsoft 44%, Amazon 52%, and Google also the worst performer of these, but that was also up more than 34%. Now, let's take a look at ETFs. So this is a very popular index, and as I mentioned earlier, it holds 100 largest non-financial companies listed on the Nasdaq, not necessarily technology companies, companies from other sectors as well, just not finance. And it is tracked by funds with over 300 billion in assets globally. Now, in the US, the most popular one, and in the world, the most popular one is the QQQ ETF, which has 214 billion in assets and has an expense ratio of 20 basis points. In 2020, Invesco launched a cheaper version of this ETF, QQQM, which has already gathered over 14 billion in assets and charges slightly cheaper, it charges 15 basis points. So traders love QQQ because of its liquidity, massive size, but for long-term investors, QQQM is the right ETF because it is cheaper, lower expense ratio, and in full disclosure, I do own it in the ETF investor portfolio that I manage. Now, if you want to take a look at the holdings now, let's go to the code page on Zacks.com. You can read our research report articles, and basically both these ETFs, QQQ and QQQM, they will have the same holdings because they track the same indexes. The difference is in the size of the ETF and the expense ratio. So these are the holdings currently after the rebalance. So I have a slide which shows exactly what changed in the index. So Apple had very little impact. It was from 12.2 went to 11.6. Microsoft and Nvidia saw the biggest cuts, about 3% each. And others also saw some cuts. Avago was one of the biggest beneficiaries. Its weight increased from 2.5 to 3.1%. Now, all these stocks are so liquid and so heavily traded that front running these rebalancing announcements has become almost impossible, even for the most sophisticated active traders. So that is why we have seen that these stocks mostly have actually gone up since this rebalancing was announced on the 7th of July. The only stock which has gone down since the announcement was Tesla, because after it reported earnings and Elon Musk talked about profitability concerns and the probable need of further price cuts. So Tesla shares are down since the rebalancing was announced. And the two which saw the biggest cut, Microsoft and Nvidia, are actually the best performers, because these are the most obvious beneficiaries of artificial intelligence boom. So they have continued to go up since the rebalancing was announced. Thanks for watching. Make sure to check out zacks.com/promo for an interesting offer. Also, make sure to subscribe to all our videos, our video channels, so that you do not miss anything. And I'll see you next week.